Good morning, everyone. Good morning, everyone. My name is Hunter Pierpont. I am the Vice President of Programming for CFA Atlanta. Thank you very much for spending this hour with us today. It's very good to have you, and we're looking forward to our presentation from Mr. Carter. A couple quick notes. This will be a webinar series. This is Investing in the Great India Internet Story. And we're looking forward to hearing about the internet market and the opportunities there. Upcoming events, please register now for our fireside chat with Mark Lasry of Avenue Capital. That will be June 13th at the St. Regis. That's going to be a wonderful evening. And Wes Durham, who's the voice of the Atlanta Falcons, will be moderating it. So please join us on June 13th for our annual meeting. And then we have an annual member appreciation night on August 1st at 5:30. And all of that information is on our website. So today, I'm going to pull up his bio here. Mr. Carter is the founder of EMQQ Global. He's been very successful over the past 2 decades, starting fractional share brokerages that were sold to ETRADE. He then got into direct investing and sold a business to Natixis. So hopefully we get to hear a lot of the background and his success over the past couple of decades. Lately, he's launched EMQQ, and he's really focused on emerging markets and specifically in the internet opportunities. So Mr. Carter, please walk us through kind of how you built your business, what you're doing today, and then some of the opportunities you're seeing in India. Thank you very much. And we'll have, pardon me. Yeah, we'll have a Q&A at the end. So please enter any questions you have for us. And Mr. Carter, take it away. Thank you.
Okay, great. And thank you so much for the intro. And thanks everyone for tuning in today. So I'm going to go pretty fast, I think, pace-wise today, but I'll use a lot of pictures and I'll get through the whole thing. And I hope that you'll find it of interest and of value, and that in particular you'll have perhaps a better understanding of India and what is happening in that particular country right now, which is a big deal in my opinion. So just to give a quick lay of the land about what I do and my business, we have 3 different ways to invest in the emerging markets internet story. Our flagship invests in all emerging and frontier markets. And again, just the internet companies, just the FANG stocks, if you will, of the developing world. So our flagship offering, 10 years old, is EMQQ. That's the whole universe. And then we just leave out China to form our FMQQ ex-China version. And then, as mentioned, and the focus of our recent efforts has been on India, and we isolate just the Indian internet companies in INQQ. But in terms of myself and how I got here, I live in San Francisco, actually 15 miles east of San Francisco. I've lived here my whole life, except for a few years off at college. And when I got home from college at the end of 1991, I got one interview in downtown San Francisco in January of 1992 with an investment bank called Robertson Stephens and Company. Some of you may remember Robertson Stephens and Company. It was the leading technology-focused investment bank through the 80s and 90s and headquartered in San Francisco, acquired by Bank of America in the year 2000. And my interview there was about 20 minutes long. We talked about college basketball for most of that time. And at the end, I was told I could start Monday. And I said, well, how can I start Monday? I don't know anything about investing. And the person said, well, go buy this book and read it over the weekend. So I went to the bookstore on the way home and found this book and brought it back to my house and read it over the weekend. And I showed up Monday morning to go to work. Now, I'm sure some of you know this book. In fact, I'm sure some of you have even read this book. This book was first written in actually 1973 originally. And in the first edition, the author, Burt Malkiel, who's a Princeton economist, he suggested that somebody make an index fund because there were no index funds 50 years ago. And Burton was one of a few people that had been talking about this as an idea. And in that first edition, he wrote these paragraphs, his suggestion for a new type of investment instrument, which is an index fund. Now, he suggested the New York Stock Exchange do it, but if they didn't, he said he hoped somebody else would. And sure enough, his friend John Bogle, a year or two later, started the first index fund, and Vanguard, and a revolution was quietly begun. Now, Burton was also the chairman of the committee that created the first ETF, the Spider. So this book and this guy, Burt Malkiel, are really parts of the foundation of indexing. But I am first and foremost an Omaha person. When I started in the first decade of my life, I was seeking to figure out, what does Charlie Munger do? What does Warren Buffett do? And so I look at every business and investment situation through an Omaha lens first and foremost. But I've been partners with this guy for the last 25 years. Now, I won't go into how it all started, but in 1999, I had an idea of my own. And I had decided that there was a problem with investing in the stock market, which it was really hard to do for most people, because if you wanted to buy a stock back then, you had to buy 100 shares to get the $29 commission from Schwab, which was the lowest commission. But 100 shares meant on average about $3,000, because the average stock price was $30 a share. And so most people couldn't put money into the stock market without going through a mutual fund. And so I conceived of and designed and filed a patent on a process for fractional share brokerage, dollar-based investing. We built this brokerage called eInvesting, and just as we were preparing to launch, ETRADE heard about us and showed up and asked to buy the company, which we sold to them in the year 2000. Now, soon after that, Burton and I came up with another idea that we thought would be a good advance for the investment world, which was we called it active indexing. I'm sure some of you are familiar with what's now called direct indexing. We didn't call it that, but somebody changed the name 10 or 15 years ago. But this idea to build index-based separate accounts was very novel, and everyone said we were crazy, and why would anyone do this? And the answer was because you could beat the index on an after-tax basis if you're a taxable investor. And of course, you could also customize. So we built this business and sold it to Natixis in the very last month of 2004. But just before that, a few months earlier, Google went public. And when they went public, they asked my partner, Burton, who was the chief investment officer of Active Index Advisors, they asked Burton to give a talk to their employees about investing. Now, I wasn't invited, but I had dinner with Burton the night before. And of course, everyone was talking about the Google IPO. And a few months later, my phone rang. And it was a guy at Google. And he said, hey, I heard about this active indexing. I want to invest with you. I want to make my own custom S&P 500 strategy. And I said, well, that's great. Who's your advisor? And he said, well, I don't have an advisor. And I said, well, we work with advisors at Morgan Stanley and Credit Suisse and Deutsche Bank. And so if you find an advisor there, we can do this for you. And he said, well, I don't want an advisor. And he basically talked me into becoming his advisor. And so I drove down to Mountain View and I sat down with this guy and explained what we did. And he said, okay, well, how much money should I put in the active S&P 500? And I said, well, I don't know, how much do you have? And he told me that he had an awful lot. And I said, okay, well, that's good. You're rich, so you should probably be conservative. And then I said, but you're 25, so you should be aggressive. And I said, I don't have a pie chart with me, but we'll call you moderate. And, maybe that's 20 or 25%. And he said, okay, well, what about the rest of my money? And I said, well, we don't do that. And he said, what would you do? And I said, I would just use a bunch of ETFs for all of your other asset classes and keep the cost down. And he said, okay, can you do that for me? And I said, sure. So all of a sudden in 2005, in the first quarter, I start going down to Mountain View and become this, my side job becomes advising this guy on his portfolio. And then he starts introducing me to other people at Google And next thing you know, I've got a dozen Google engineers and I'm going down to Mountain View every week. But when I start going to Mountain View, Burton starts going to China. Two of his Princeton colleagues were Chinese economists. They had been offered a lot of money to go back and teach economics in Beijing. And they convinced him that he has to come and visit and see China in person and watch the incredible growth that was happening. And so Burton starts going back and forth to China when I'm going back and forth to Mountain View. And he ends up writing a white paper with these two guys that gets published in the Journal of Investment Consulting and later became a book. And the Google people heard about it and called me and said, can Burton come down and talk about China? And I said, sure, next time he's in the Bay Area, we can set that up. And 18 years ago, last month, I picked up Burton one morning down by the airport and we drove to Mountain View. And he gave a talk about China. And when he was done, all of these people looked at me and said, we want to invest in China. Now, I had no idea at that moment that my life was going to take a hard right-hand turn, and that from that point forward, my entire life would be dedicated to figuring out what on earth does that mean to invest in China and how in the world do you do it? So that's kind of how I got here and what I've been focused on now for a while. But let me tell you the basics of what I learned, most of which I learned on the first day, and they still remain the most important parts of the story. And in fact, it's what has led me to create EMQQ. So when we look at emerging markets on a map, where are these places? The scale, the size of these regions by population, by GDP, by stock market value, this is mostly Asia, 60% Asia, with China and India being the largest parts of that. 15% South America, mostly Brazil and Mexico. And then the other 25% in dark gray, you can see it's all over the place, from South Africa to Morocco to Poland and Kazakhstan. So all over the place for the other part of this. And now the case for emerging markets has been pretty much intact. At least the story has been intact. The promise, if you will, has been intact. And that is that emerging markets have a lot of people that are young. Their economies are growing faster, and that's driving massive consumption. And all of those things remain true. Emerging markets have about 85% of the world's people. They are younger, and so they have almost 90% of the future in terms of people. Their economies aren't just growing faster, they're now meaningfully larger than the developed world economies. And finally, what is that driving? Massive consumption. And you can see at the bottom of this story that McKinsey calls this the biggest growth opportunity in the history of capitalism. And what we're talking about is 6.5 billion people that want stuff. They want all the stuff we've got. They want more and better food, more and better clothing. They want appliances, a heater or an air conditioner. They want to go to a movie, take a vacation, get on an airplane for the first time. They want a motorized vehicle, hopefully with a battery, and they want their kids to go to Harvard. And I didn't have to figure that out. It was very well documented by the time I got involved. And even if McKinsey's wrong and it's the second biggest opportunity in the history of capitalism, if you're going to invest in emerging markets, this is what is emerging. 6.5 billion people that want stuff. Now, here's the only other major thing to report on my 20 years in emerging markets, and it has to do with a real problem. And the problem is the index itself, the MSCI index, which most people use. The other single country indexes, these are a terrible way to base an investment portfolio. And I learned about this literally in the first 5 minutes. So after we got back to San Francisco that day after Burton's talk at Google, I walked straight over to the portfolio managers and I said the following. I said, the Google guys want to invest in China. Give me a list of all of the companies in the China ETF, because there was one China ETF on the planet that day. It has the ticker FXI, the original iShares China ETF. And I assumed that's what we would use for these Google people. But since I'm an Omaha person, I don't care what the name of the ETF is. I want to know what are the businesses we're going to own. And so I asked for the list, and that's when Burton pulled me aside and said, Kevin, when you get the list, you're going to see that most of the companies are Chinese government-owned banks and oil companies, state-owned enterprises. Now, that didn't sound good at all. And then he started giving me examples of how a Chinese state-owned bank might make loans to bankrupt companies just to make sure the employees stayed on the payroll. And that made me nauseous when I heard that, because, in Omaha, investing is really simple. The reason any business has value is because it makes profits for the people that own the business. And the only way to grow the value is to grow the profits. And if you're telling me that these companies and the people that run them don't care about that, why would we invest in them at all? Now, the China index was 80% state-owned enterprises, and it was less than 10% in the consumer sector. And so right away, I saw this big mismatch. You want this incredible story of consumption, but we're going to give you 90% or 85% legacy banks and oil companies. And so this problem is not as bad in the broad indexes, but it's still pretty bad. It's about a third of the broad index, and you don't have to look very far. You can put any state-owned enterprise in Google and add the word scandal, and you'll get hundreds of stories about that particular company. Petrobras in Brazil, probably the best example of this problem. So the other problem, by the way, I'll just mention while we're here, most of the internet companies aren't in the index. After I got the list, after Burton gave me the warning and I got the list of all the companies in the China ETF, I got to the bottom and I didn't see Baidu. Baidu wasn't in the China ETF, even though it was public before Google was. So we called the iShares people and they said, well, we don't consider it a Chinese company because it trades on the NASDAQ. And I said, that's crazy. It's the Google of China. And it seems like it's good to be the Google of anything, especially the world's largest country. So the internet is largely not in the index, as we'll talk about. But either way, look at what you've gotten if you bought the index. The black line at the bottom, that's the return of the FXI over the last 15 years. And you can see the Chinese GDP has grown 430%. So the economies may grow, and they have grown, but investors have been failed by these legacy indexes. So what you need to do, in my opinion, is evolve the way I watched the Ivy League endowments and other institutions evolve. So my first half of my China life, Burton and I launched a number of China ETFs with Guggenheim Partners that now are owned by Invesco. But when I wasn't with the Guggenheim people, I spent most of my time in New York and Boston, and I watched how people like Harvard were basically doubling their allocations. But in the case of someone like Yale, they would get a little bit more targeted. And if you were David Swenson at Yale, you could take your smartest Chinese alumni and start a private equity fund that worked very well. But most people couldn't start their own private equity fund in Shanghai. So when people would ask me, what's the best way to invest in emerging markets? I said, that's easy. You just buy the consumer stocks. And what happened was 10 years ago, when people would ask me what's the best emerging markets ETF, I would say buy the emerging market consumer ETF, right? If you believe this slide, there's a ticker and it's ECON, and it owns the 30 largest emerging market consumer stocks. So the food and clothing companies. And so that's what I told people to buy. And 10 years ago, I got a call from a friend and I answered it on my iPhone, my first iPhone. And my friend said, what's the best emerging markets ETF? And I started to tell them to buy the emerging market consumer ETF. And that's when I had a light bulb moment and said, wait a minute, the best emerging markets ETF doesn't exist. And I went straight back to my office and started working on EMQQ, which launched basically 100 days later in November 2014. And that light bulb moment was, what happened was the morning that I got that call, I had been looking at my own portfolio and I had 5 stocks. All 5 of the stocks were part of this story, but only 3 of the stocks were in the emerging market ETF, the emerging market consumer ETF I mentioned. The first 3, food and clothing companies in trading in Hong Kong, Want, which is like Nabisco, and then Li-Ning and Peak Sports, which are like Reebok and Converse sportswear. So those are my first three stocks, all of them consumer stocks in the database and included in the emerging market consumer ETF. But I had these two other stocks that were definitely part of this story, but they weren't called consumer stocks in the database. They were called technology companies. The first one, the Craigslist of China, Wuba, which traded on the New York Stock Exchange, was later acquired. And the fifth and final company was Mercado Libre, MELI on the NASDAQ. I know some of you know this company. This is the Amazon.com of Brazil. And so when I looked at my own stocks that morning, I was like, well, all of these are consumer stocks. The ones that are called consumer stocks are growing at 15 or 20%. The ones that are called technology stocks were growing at 120%. And while the PEs were higher, the PEG ratios were lower. So that was what inspired EMQQ. And what wasn't as clear to me then as it is now is that essentially there's three things happening on the planet right now, three mega trends that are one directional, and they are very big, and they're still pretty early. And you and I are part of all of these trends, but we've been part of them for generations now. And so we don't think of them necessarily as trends. So what are these three mega trends that EMQQ captures? The first one is this. We've already covered it. I've had plenty of food and clothing and vacations since I was a kid, as had my parents. My brothers and I went to college, as are my kids. So we've been in consumption mode for a while. Most of the world's just getting involved. Now, when I got that call 10 years ago, I answered it on my iPhone. So I had an iPhone 10 years ago, but it was pretty new. I might have had it for a year and a half or 2 years at that point, and I could already see how it was changing the way I was consuming. But I had a computer for 20 years before I got my first smartphone. Well, guess what? The computer is the second mega trend, something we definitely take for granted. I, again, had a computer for decades before my first smartphone. Well, most of the world is getting their first computer today. 7 million people a month in India right now getting a pocket-sized supercomputer, their first ever computer. And it won't be a desktop ever. And in 95% of the cases, it does not have an Apple logo. The Android-based smartphone is bringing the computer to the world at an incredible rate. Every year, they get better and more affordable. And when that emerging market consumer gets that first smartphone, they're also getting the third mega trend, which I first got in 1995 on a telephone line in the Marina District of San Francisco. The internet. So we've been wired for a long time. Obviously, the internet from 1995 and 1996 is nothing like the internet today, but we've had the internet for decades now. Most of the world never got wired. So billions of new consumers are getting not only their first computer, but also their first access to the internet. And very importantly, because they've never had a bank account or a credit card or a debit card, and they probably don't have a car, and there's no Target stores, these billions of consumers are leapfrogging, and in many ways are more digital than we are. And the result of this is massive growth. This is showing you the revenue for the entire emerging markets internet sector going back 15 years. Now, when I launched in 2014, I had this slide, but it stopped at 2013. And I gave my first CFA presentation for the CFA Society of San Francisco. I offered the audience a ham sandwich if they could show me a sector that had ever grown as fast as this sector did from 2009 to 2013. Now, I raised my reward I offered a ham sandwich if anyone could show me a sector that ever grew that fast. And I still offer reward. Now my reward's $100,000. If you can show me a sector that ever grew at an average of 35% for 15 years, then I will give you $100,000. Now, there's some rules, including you have to be public companies, and there has to be enough to make a full index. But either way, I'm not positive of anything in the world, but this is a lot of growth. And so far, my inbox is empty. So that's the main story. This is a story of growth. And now, obviously, the returns for investors in gold have taken a pretty bad turn to the south in the last few years, but are still 30% above the traditional index over that period. Now, we'll talk about that crash a little bit later, but you'd think that the story was crippled, but the growth continues, albeit at a little bit slower pace, as we'll discuss. So now this has been largely a China story. Alibaba and Tencent have driven this. And so if we look at China, the reality is that it is an emerging market, and it's going to be an emerging market for a long time in a traditional sense. But when it comes to the internet and e-commerce and smartphones, China is the most developed country on the planet by a mile. China's e-commerce at the top here dwarfs our e-commerce, and it's 4 times bigger than all of the other emerging markets combined. So China might be an emerging market, again, in a traditional sense, but it's a lot more like the Jetsons when it comes to smartphones and consumption. Now, if we go back and look at that same revenue, this time you're seeing China in gold and the other 45 emerging markets in purple. So this has been really a China story more than anything else, going back to 2020 or to the beginning, about 80% China. But that purple area down there at the bottom, it has 4 times as many people as China. And while China's e-commerce market is very well developed, everyone else is just getting started. So I don't know how long it's going to take, but I'll bet you a ham sandwich that purple revenue is going to go up 10-fold and probably 20-fold. And my best piece of research is that I've never known anybody that used to have a smartphone. And these people are just now getting their smartphones, and there's 3 billion more people coming. In purple, you can see the smartphone population for emerging markets ex-China compared to China in gold and the US in gray. So this is still early in what we call the third wave. So if we think about when did human beings, millions of them, first have computers, access to the internet, websites and businesses that would buy something, or places you could buy something or sell something. That basically started in the year 2000 in the United States and other developed countries. And what happened? The FANG stocks took over our lives and our stock market. First on PCs, then on smartphones. That was the first wave. The second wave was China, and you saw what that looked like. Right behind us, 2005 and onward. And now the third wave is here, and India is the biggest part. So now, as a business, we've been waiting for India for a long time. When we launched 10 years ago, we had 60% weight in China and 0.5% in India. 3.5 years ago, same, 60% China, less than 1% India. But you can see that India had about 25 IPOs of internet companies right during the heat of the COVID. And so we finally had enough to launch an India standalone product. Now, because we didn't have a lot to talk about, we used to have this slide. And we featured Modi and said, well, maybe you're afraid of China and it's got a communist government. Well, there's a big democracy in the neighborhood, and it's got a bunch of unicorns that we're waiting for them to come public, and maybe they will eventually, but the country is doing a lot to embrace technology. And I had these logos at the bottom in my presentation, but as I'll show you, these are really important parts of the India story, more so than I think anybody understands, and not even myself until a couple of years ago. So finally, India is here. My world and our versions of it has gone from 0, in the case of the broad index, all emerging markets, internet companies, India went from less than 1% to now 17%. That essentially doubles if you leave out China. And then, of course, we have an India-only version of the story. So now let's talk about India. And, this slide, this is posed as a question, but it's not a question. It is a fact, in my strong opinion. And I will show you why I feel confident in making the statement that India is the perfect emerging market. So if we go back to the beginning, why are we investing in emerging markets in the first place? They have a lot of people, they're young, their economies are growing fast, and that's driving consumption. And if that's the checklist or the report card for grading an emerging market, it's not only is it number one, it's number one by a mile. So let's first talk about the size of India. As you can see here, the orange line, India's population has now passed the gold line, China. And you can see that as the years go on, India is getting bigger and bigger and bigger, and China now has a demographic challenge. It has the demographics of a European country. India, meanwhile, set a record today as the largest population ever. Tomorrow, it will set a record as the largest population ever. And every day for many decades, that day will mark a new high in terms of largest population ever. And there isn't anything else like it coming. In fact, not even close. India is bigger than every other emerging market combined if you leave out China. So Indonesia, Brazil, these countries will never be anywhere near what India is in terms of size. So the scale of this is really on a whole nother level. Now, it also, within that, has incredible demographics. This is just one simple way to look at it. India has twice as many people under the age of 30 as the entire US population. They have the fastest growing economy. Now, this chart says 6.5% for India, which you can see puts it well above anything else. But the reality is they've beaten that number 3 quarters in a row. And in fact, the most recent quarter, they reported 8.4% growth, almost 2 percentage points higher. So I believe India's economy is going to grow faster than 6.5%, which remain the majority of the estimates. That I expect to see all of the estimates up over 7% pretty quick, because I believe India's economy may be accelerating. I'll show you why. And what is happening below all that? It's driving the same thing we saw in China. A whole bunch of people that want stuff are getting stuff. The households of consumers is exploding. And when you take all the numbers and combine them, the OECD says that India is not only going to pass China for consumption, it's going to be meaningfully bigger in 25 years, almost twice as big in terms of consumption. So if those are the things you're looking for, you're not going to find this ever again. This isn't a once in a lifetime thing. This can really only happen once. Now, why is this happening now? Where has India been? Why should we believe this is finally going to happen? Well, here's why I think this is happening and going to continue to happen. The first is leadership. Just as Deng Xiaoping unleashed capitalism and free markets in China, Modi is doing the same in India. Now, the situation he inherited isn't the same, but the challenges are similar. So Modi is the biggest reason this story, I think, is finally getting moving in India. So for those of you who don't know, Prime Minister Modi has just finished his second 5-year term. So he's been in office for 10 years now. They are in the middle of an election, which will end on June 4th. And he's almost certain to win again. There's no term limits, and he could theoretically get a 4th term if he wants in the next 5 years. So now he's very popular. He's got a very high approval rating. And most importantly, he's running the country like a business. India has so much socialism baked into its recent history. It has so much bureaucracy left from the British, and it's held the country back. And Modi isn't taking it any longer. And he's doing all sorts of things to make it easy to start businesses, easy to go bankrupt a company, make it easier for foreign companies to come in. And he's cut out all sorts of red tape, simplified the tax code, and he's finally got the country investing in the infrastructure it's so badly needed. So when I got involved with China 20 years ago, India and China were neck and neck. They had almost the same size GDP, but every year you saw China pull ahead, and it was mainly because they were building the world's greatest infrastructure. At the same time, India, with all of its bureaucracy, they couldn't even get the power grid to work. You'd get stories about brownouts, shutting down factories on a regular basis. So it was a very poor infrastructure, and Modi's basically poured money into it. He's in the first 10 years, he's doubled the country's entire infrastructure in almost every category. And he's working off $1.5 trillion master plan that includes everything. The British left a lot of trains. They've electrified most of them. They're building new stations, updating the stations. They've got their own homemade high-speed trains, hundreds of which will roll out in the coming few years. You've connected and are connecting the major cities. This looks exactly like my first trip to Shanghai 18 years ago. The airports are booming. Getting on a flight for the first time, buying the $29 ticket on Indigo Airlines, the number of people that will begin traveling is going to explode. They're going to have to triple the number of airports in the country. And they're working on the deep sea ports, which they're going to need if they're going to get jobs from China. Now, this whole friendshoring, nearshoring, diversify your supply chains, whatever you want to call it, take jobs out of China and put them somewhere else, that's happening. And there's a number of factors that are pushing this to happen. And that is going to benefit India. Now, they need it to continue to happen. They need a lot of jobs. Apple is helping with that. Apple's going to make up to a quarter of their iPhones there by the end of next year. So the jobs will come, but they need to continue with the infrastructure investment. Now, here's where India just sets itself head and shoulders above everything else. So India has a technology sector that is older than I am. Tata Computer Systems, as it was originally called, was founded the year before I was. So you have this ecosystem of publicly traded technology companies, publicly self-made billionaire founders. They've been publicly traded for decades, and they've employed hundreds and hundreds of thousands of technologists. So you have an ecosystem in India that's unmatched. You have an educational system that includes 23 IITs, many of which rival Harvard. You've got another 20 or 21 institutes of management that have, a lot of these kids get into our best colleges, and half the deans now in our best business schools are Indian, but there's still plenty of good educational opportunities for Indians to learn technology and management. In fact, 2 of those former students now run Microsoft and Google. Both of these guys came over on temporary work visas originally. There are 25 S&P 500 companies that have Indian CEOs. So you're not going to find this in Indonesia or Vietnam or Colombia or any other emerging market. Indeed, probably not every other emerging market combined. So, and this is an important part of the story. So not only does India have all these basic building blocks, it has a talent pool that's unmatched and has been somewhat electrified in the last handful of years. So now let's talk about the final piece of why I'm so bullish on India and why I think it's better than people understand. Because when I talk to investors right now and I ask about India, they say the following to me, almost every one of them. They say, first, they say, yeah, India looks really good. It looks really compelling. And then they say, but it's really expensive. The stocks are really expensive, and I'm gonna hold off because I think the Indian stocks are expensive. So here's what I'm gonna tell you. First of all, I don't make market predictions in the short term or midterm even. So I don't know if they're gonna go up or down anytime soon. But I don't think they're expensive. And I think India is better than it looks. And the reason is because, and I talk to a lot of investors, 99.9% of them don't know about this part of the India story, the India stack. And I'll assume that none of you are familiar with this part of the story. If you are, by all means, send a note or otherwise let me know. But let me tell you what the India stack is. The India stack sounds really boring, which is why, the first couple of years I heard about it, I just kind of ignored it. I didn't really find it of interest, but I'm glad that I finally dug in a couple of years ago, and now I see this genius platform the country has built. So the India stack is India's homemade digital public infrastructure. Now, what is digital public infrastructure? That sounds really boring. Well, you use digital public infrastructure every day, including right now. So the best examples of digital public infrastructure are the internet. It's digital, it's public, anybody can get on it, and it's infrastructure. It's like the plumbing for the information age. So So we all use digital public infrastructure in form of the internet. Another good example is GPS. I didn't launch a satellite, and you probably didn't either, but now somehow if I go out on the street, I can push a button and a car will pick me up and it knows where to bring me. So those are the two best examples of digital public infrastructure. India has made its own, and if you wanted to make a picture of it, it looks like a stack of pancakes. So that's why we call it the stack. And now let's review what these layers are. The first layer at the bottom is called ADR, which is the logo here in the lower in the orange. This is an identity layer. There's a payments layer. There's an e-commerce layer. But let's go back to the beginning. Okay, what exactly are these things? What do they do? How did they get here? This is the hero of the story. A lot of people think Elon Musk has done a lot of great stuff for the planet, and I think he probably has. This guy's got to be up in the top 2 or 3 list of people advancing the cause of the world. So this is Nandan Nilekani, and he is one of the founders of Infosys, a multi-billionaire. He's currently the chairman of the board of Infosys. And the way this India stack started was in 2009, the Indian government decided it was finally time to give everybody in the country a national identity card, like a driver's license, a physical card issued by the government where everybody's picture and information would be, and it would also have their own unique 12-digit identification number. It was a unique identification system. And they asked this man to be in charge because one of the problems that India had, that was a serious problem, was in terms of development, nobody had identification. Only 40% of the babies got a birth certificate. So it was kind of a free-for-all. And so they finally decided they should start this program and give everybody a card. They asked Nandan Nilekani to be in charge. And he said, I'll be in charge, but if I'm in charge, we're going to do it my way. And that's going to include a lot more technology than you guys in the government are used to. And so they launched this program in 2010. And when they launched it, they, at Nandan's insistence, not only did everybody get a physical card, but they also had their fingers and eyes scanned so that every 12-digit number could be linked to a human being with biometric information. Now, I don't remember hearing about that part, but I remember they launched this and I added the logo to my coming soon slide. But I didn't pay attention, and I don't remember the last part of this, which is that in 2014, 4 years after they launched it, they set up a program whereby you could walk into any bank, and if you were in the database, you could instantly open a bank account with no paperwork in less than 2 minutes, just by looking in a camera and putting your fingers down. Now, this was all voluntary. Nobody was required to enroll in this. Look at what has transpired in this system. Again, I didn't realize this until 2022. I knew about the program, but I didn't pay attention. 95% of the country is now in the ADR database. ADR, by the way, means foundation in Hindi. And they've used the KYC, know your customer functionality, to open 800 million digital bank accounts. So you've taken a population of 800 million people that were, their entire financial life was paper-based, with no digital currency, no bank account. And not only have you brought them into the banking system, but you've done it in a digital way. So now notice in the middle that they passed 1 billion people in the system in April of 2016. And what happened after that, and it wasn't planned or coordinated, but there were several things that happened in a 12-month period that sent India into a hockey stick of digitization. And so let me show you what went on in the following 12 months. So they reach 1 billion people. A month later, or rather a week later, they launched the second layer that I showed you, the payments layer, the unified payments interface, QR code-based payments. Now, when they launched this, I didn't understand. It got a lot of hype, but it was QR code-based payments, which was old. You know, that wasn't cutting edge. In Brazil, Mercado Libre had blanketed the country in QR codes. In China, everything had a QR code on it, including the chickens and the beggars. And so this wasn't cutting edge, but what I didn't pay attention to was this important detail at the very bottom. This isn't just QR code-based payments. This is instantaneous transfer of my money from my account to your account with zero cost, friction, or delay, just instant. And you can send it back to me and we could send the money back and forth a million times. And if it was 1,000 rupees to start, it would stay 1,000 rupees. So they launched this. I added the logo to my slide, but I didn't watch what happened. Now, a few months later in the fall, Reliance Industries, a private company, launched the first 4G network called Jio. And this was important because at the time there was 10 other carriers, all of them on 2G, constantly in a price war. Nobody had money to invest in 3G. Mukesh and Reliance spent $25 billion to launch Jio. They had Facebook and Google as investors. And they launched the first 4G network, covered the whole country, ready for 5G and 6G. They had an unbeatable offer, which was, we have 4G and nobody else does. We'll give you unlimited voice calls for free forever, and we'll give you 6 months of unlimited data. And then when your free trial's over, you'll have the lowest cost data in the country. Now, when they launched, they had a goal of signing up 100 million people in the first year, which seemed ambitious because it took, on average, it took about 3 hours to get a new smartphone if you went into the Vodafone store or the Airtel store. But the entire India stack has got open APIs, so private companies can use it. And Jio, their in-store sign-up included just thumbprints and looking in a camera. And they signed up 100 million people in 3.5 months. And now they have close to 500 million people on the Jio network. So you've used this database to bring 800 million people digitally into the bank account. And now you've given 500 million people their first internet connection. It's 5G across the country, and it's basically free. It's the cheapest data on the planet. Look at this. We pay 50 times as much for a gigabyte, and the Indian smartphone user on the far right, you'll see, is using more data than anybody. So again, the power of this stack, first commercial aha moment in the fall of 2016. Now, right after that, or as that was happening, they also took the large denomination bills out of circulation. India had a really informal economy, all cash-based, no one paying their taxes. And to help push digitization, they pulled all of the large denomination bills out of circulation, which was very controversial. And then, perhaps most importantly, they simplified the tax code, which people also thought was going to be a big problem. And they went to a simple goods and service tax from a horribly complicated previous tax system. And now look what has happened. This is basically the digitization of India in a chart. So the black bars represent UPI payments starting in 2016. You can see the demonetization and tax reform called out in the beginning of this. This is showing you that now the country's doing about 13 billion monthly UPI transactions. And to put that in perspective, that's now more than half of the entire planet's real-time payments. There's only 300 million Indians using this so far. So only 20% of the population is using it. And it's growing still at 55%. And this has driven the entire Indian economy in 7 or 8 years now from 95% paper-based cash to 80% digital. People are paying their taxes. The tax collections are exploding. They're growing faster than the economy. They're pouring that into infrastructure. So there is a virtuous cycle that the efficiencies and speed of this stack have provided. So there's a lot more to the stack. I'm going to move on from it and get to the conclusion. I think I'm running a little behind schedule here. But so is India like China 15 years ago? In some ways, anecdotally, it is. China had its first Apple store 16 years ago, and last year, 15 years after China, India opened its first 2 Apple stores in Bangalore and Bombay. GDP-wise, it's pretty similar versus China 15 years ago. But notice at the bottom of this chart, we have smartphone penetrations. Well, guess what? Nobody on the planet had a smartphone 15 years ago. And now that what makes the biggest difference is that when India is entering this phase, you can get a brand new smartphone for $12. So the arc of consumer technology in just those 15 years has been nothing short of staggering. And now we went from, a period when there was no smartphones, or there weren't quite yet smartphones, and now you can get a brand new Jio Bharat phone for $12. And you have in India this genius of a system that Nandan Nilekani has overseen. He's continuing to oversee a series of nonlinear changes, some step function sort of changes, and several of them, and they interact and have created this really unprecedented situation as this economy takes off, and in a highly digital way. This really is, I think, India's secret weapon. And I am very confident that the average investor does not understand this incredible operating system, if you will, that India's got for itself. So now, okay, fine. We want to invest in India. 15 years ago, if we just bought the China ETF, we lost half our money. What's going to happen if we do that with India? So the biggest India fund that most people use is the INDA. That's an iShares fund that tracks the MSCI index. And it has the state-owned enterprise problem, but it's not nearly as big a problem. It's only 10%. And actually, and this is very unique, it looks like India's state-owned enterprises might get privatized in a way that actually leads to shareholders making some money, which we haven't seen on anywhere else on the planet. So this 10% it's certainly not as bad as what we saw in China, and it may actually turn out to be a value sector, if you will. But they've had a lot of scandals in the past, including this massive coal scandal. And then now here's the other problem, though, with the index. The biggest companies don't get any revenue from India. You can see Tata, Infosys. These might be great companies, but almost all of their revenue is exporting services to the Fortune 500. So, not really a play on the growth of India directly. And they're not really growing. You can see in the fourth quarter, they barely achieved any amount of growth for that sector. So, and again, you can see, they're growing about the same as the entire Indian economy, whereas the internet sector should grow a lot faster. So, in fact, not a lot faster, but it should explode. It's already happening. You can see here the estimates from Temasek and Google. And what are these companies? The same kind of apps you probably have on your phone. Make My Trip, which I've used myself to book a train or a hotel or a plane ride. This company is incredibly profitable. This is like a Craigslist, if you will, actually more specialized. They've got the leading job site and the leading real estate site, which is a very strong cash flow generating business. This company also has invested in 20 other companies, including Zomato, which is not only the food delivery leader, but it's also got the fastest growing segment, which is called Blinkit, which is quick commerce, which is basically 10-minute delivery of anything you want. Online insurance, all of these, you look at the demographics behind these and how low the penetration is. These companies have decades of growth ahead of them. Online beauty products. Think of this company as Sephora for India. And interestingly, the woman that started it was an investment banker until she turned 50, and she had promised herself she would become an entrepreneur. Online gaming, and finally online payments. Now, Paytm, which was backed by Berkshire Hathaway, this company went public at the very top of the Indian market. I did a series of CFA presentations a year ago in India, and in every one of those presentations, one of the main questions I got, which was also a comment, was, why would I invest in the Indian internet companies? They're a terrible investment. And the reason is, Paytm went public at the very, very top of the Indian stock market, and India's internet companies had a bubble and it burst. And Paytm, you can see, is now down about 78%. And all of these companies had pretty large declines. But the second thing they said to me was, none of these companies know how to make any money. And that's just not true. Only one of these companies isn't profitable, and that happens to be Paytm. And not only are they profitable, they've got a collective operating margin of 28%, which is pretty solid. Now, is India expensive? Well, okay, here's the PE multiple. And I think this is what most people look at and say, yep, India is real expensive. I don't want to buy it because it's so expensive. But the PE multiple doesn't mean anything to me without the G and the growth rate. You're buying the future, so the slope of the curve matters. And so the PEG ratio actually only 1.2. So, if you think that's expensive, then yes, India is expensive, but I don't think that's expensive. It's certainly higher than a lot of other emerging markets, but it's also maybe the greatest emerging market ever. So let's talk about the risks. The biggest risk is Modi. He is the embodiment of the story, and he's going to get a third term, and he's in good health and relatively young, so there's no sign of him leaving, but you never know in this world. Lots of strange things could happen. There's been and continue to be a lot of tensions between religions and other ethnic groups in the country. It's a very diverse country, so there's lots of scuffles around the edges at all times. They need jobs. They know they need jobs. A lot of people want to build factories there, so this can get solved, but until it happens, it's going to be a risk. And then some of the other issues that the rest of the world has: wealth disparity, climate change, and corporate governance, always a problem in emerging markets. But in conclusion, in spite of these risks, I think that this is a very unique opportunity. It's got everything you want. It's got the scale, the youth, the growth, driving consumption. You have a foundation that is unmatched, I believe, and a secret weapon in this India stack. And in a world that's full of tensions and geopolitical problems, India is also at a very unique place where it can buy oil from Russia and still have dinner at the White House. So that's the end of my presentation. I'm sorry I went a little longer than I think we targeted, but I can stay a few extra minutes and answer questions as they're required.
Awesome. Well, thank you very much. I appreciate you running through everything from how you got started in emerging markets to what a great opportunity you're seeing right now, which is wonderful. It was really well presented.
Thank you.
So we probably have time for 4, 5, 6 questions. I know we already have 4 questions here. Let's run through them and maybe go for about 10 minutes here and then let you go. So the first question is talking about kind of the trust issues in some of the government reported data in China, whether that's the political rating, the approval ratings, the GDP numbers. How do you take Indian government numbers at face value, or do you verify them in some other way? How do you look at that?
Well, we certainly don't try to verify them ourselves in some other way. There's lots of other organizations whose research we can access for that. But I think all of these numbers are always, they're approximations, I think, when you get into the weeds of how these things are calculated. But I think that you can trust India probably more so than China, because China had a lot of misplaced incentives where it was, there were certain members of the party that whatever regions or cities they were in charge with, they were measured by certain things and growth rate targets. So I don't think it's nearly the kind of problem it might be in China, but we take the numbers as reported by the government and other independent sources like the IMF and the OECD, et cetera.
Okay. I'll roll this question, 2 questions into one for you. INQQ has a pretty high expense ratio. Can you kind of talk about how that's built in? And then are there any, I think, do you do a lot of ADR investing? Is there any currency risk that you would be, that an investor would be taking with?
Sure, there's definitely currency risk. We don't hedge for the currency. Almost all of these companies actually trade in India. The Indian government and the regulators have made it pretty difficult for these companies to list abroad. Now, Make My Trip, the travel app, which is one of the holdings we've had from the beginning, it does trade on the NASDAQ, as do 1 or 2 other companies. But for the most part, these companies trade in India on the NYSE or the BSE. And it is hard to invest in India. There's no doubt that if an individual wants to go buy most of these companies, it's not just hard, it's actually not possible.
Okay. And then any comment on the fees of this product?
Oh, well, this is one area where you know, and I have a conflict of interest. I want your money and you want your money. And so yes, this is higher than a Vanguard fund, but you know, we believe we put in a significant amount of work and can support our expense ratio. By the way, Indian products in general are relatively high fee. So the India fund doesn't look as bad as, you know, versus other categories.
Great. There was one question, Kathy, that you put in here. So Justin asked, with so many of the record level transactions you mentioned taking place with individual vendors or local merchants, as opposed to buying goods and services from publicly traded companies, is there a direct way to invest in the rapid increase of payments to local merchants in a P2P transfer?
Sure. Well, PayTM actually is probably the best. Well, it's the purest way to invest, because the Kirana stores, the 13 million mom and pop stores, PayTM has done a great job of digitizing them. Now, the business itself has been in trouble. They've had a lot of regulatory problems, and the stock has continued to be crushed. But that is a pure play, or about as pure play as you can get. But the Zomato and its Blinkit is another way, and then you also have, you know, global companies like Google that are involved in the payments market there as well. But there'll be more of those. Another one we own is Geo Financial Services, which was spun out of Geo, which you'll see is one of our top holdings. Again, that trades in India is hard to buy.
Do you expect the number of how many holdings are in there right now? 25?
25.
20, do you expect that to expand as we have some more IPOs?
I do.
You like it concentrated for a higher beta play?
No, we'd like more companies, and we will get more companies. We could easily in 5 years have 100 companies. There's a whole lot of unicorns, and actually there's a good reason to think we'll get a few more IPOs this year. And then, you know, some of the biggest pieces of this are still private. So Geo itself isn't public. It's taken public a couple of its pieces, but it will likely get spun out or dividended out of Reliance Industries, and that'll be one of the largest holdings for sure. And then Flipkart, which is the e-commerce leader, is now controlled by Walmart, and it will also likely IPO. And Amazon and Flipkart are the two largest of the traditional e-commerce companies, and so getting Flipkart public will be a big step in the story.
Has Walmart announced a plan for a spinoff?
They've talked about it for 5 years, but I haven't seen any specific plans for the near term. But I would suspect it'll happen, conditions permitting, by the end of next year.
Okay. Alan asked about the caste system. Is that a hindrance to growth, economic growth, and consumer productivity?
It's a hindrance in a lot of ways. I mean, it's basically been banned and outlawed, and you can't make decisions based on it. But there still remains, remnants of the caste system remain, but it's thankfully going slowly away. And I think a lot of the digitization that's happening is, the playing field's getting leveled in a lot of ways. So the caste system is becoming less and less of a thing, but it's still a piece of baggage.
Is that a political effort to dismantle that, or is it just?
It's definitely a political, and there's law. I mean, a lot of laws that were passed to make it illegal to discriminate in any number of ways, including for the scheduled tribes and for the caste, the lower caste groups.
Okay.
It's an incredibly diverse country. I mean, that's one of the things that makes it very unique is they've got, like over 1,000 languages, for example, and the government actually produces every document in 24 different languages, the 24 official languages.
Yeah, that's incredible. George asked about the Chinese Internet ETF QWEB.
Yeah.
Can you compare that with what you're doing in EMQQ?
Yes, George, we should talk offline. I know all about KWeb. One of the funds I launched with Guggenheim has got the ticker CQQQ, which was sort of the original KWeb, if you will. And, in Seinfeld, they have the guy Newman, who's sort of the Jerry's nemesis. KWeb's been sort of my nemesis of my life, but I'm very familiar with it. We own a lot of Chinese internet stocks. It's, so a good portion of what we do is the same stuff as in KWeb, and the Chinese internet companies are incredibly cheap. There's no doubt about that. So I agree with that, George. They are cheap.
All right. Well, that's all the questions we have. Kevin, thank you for taking this time to spend with us. Thank you all to everyone that connected with us, and please look for a presentation, survey, and email to follow up. And I hope everyone has a great afternoon, and thank you so much, Kevin.
Thank you.
Bye.